Good day, everyone. My name is Jeff Feinstein, Managing Partner of Pinnacle Partners. We are very pleased to present to you today our webinar in partnership with BMMS Partners, our tax advisory and an expert on the subject matter, to demystify the OZ qualification criteria and to reaffirm the tax benefits that are certainly in place for opportunity zone real estate investing. This will be a highly interactive session. We've received lots of questions from investors and prospective investors, particularly over the last 30 days as we come towards year end. And there has been, as you may know, proposed legislation to extend and expand the program, and so we'll talk about that if it's applied and ratified. Again, myself, Jeff Feinstein, Managing Partner, Pinnacle Partners. I'll be joined by my co-founder, Leo Backer, who will provide a portfolio update for those that have actionable gains, interested in evaluating an opportunity zone real estate fund. Our Pinnacle Fund 8 is available for your consideration and potential investment. And then, as I mentioned, our partner who joined us soon after we founded the business in 2018, we received the opportunity zone legislation. We read through the 8 pages. We considered it to be one of the most compelling pieces of legislation ever enacted to provide significant and compounding tax benefits. Brendan McCullough, our partner at the time, gave us guidance and allowed us to execute very swiftly on the program when there was still ambiguity associated with the legislation. And he's been our partner ever since. And we consider him quite expert as an OZ tax practitioner. So we want to remind you of the tax benefits, speak to the program at large, and then a brief overview of Pinnacle Partners, and then we get into this highly interactive Q&A with Brendan. So we've accumulated some your questions in advance of this webinar. We will allow the chat to open and pose your questions there, and we'll try to exhaust all questions before moving to the Pinnacle OZ Fund 8 update, which again, my partner Leo Backer will provide an overview. So just a reminder, many of you on this call are already invested with Pinnacle Partners. Some of you may be considering to invest with Pinnacle Partners. We were an early mover, as I described earlier, with our first opportunity zone investment placed in 2018, and we've continued to be quite active, sourcing the highest quality real estate projects across the country. We have formed 14 joint venture projects. We've capitalized close to $1 billion of development and repositioning of existing assets. We'll deliver close to 1,400 multifamily units, and that reflects an aggregation of over $200 million of capital gains invested. We take OZ compliance very, very seriously. We study the regs and we consult with our experts like Brendan routinely. We test quarterly to ensure that we receive the tax benefits we have earned from the Opportunity Zone program. The benefits that the program deliver when investing a capital gain, short or long term, sourced from any sale, real estate, equities, collectibles, is first deferral of the capital gain tax through 2026, and then permanent exclusion or tax exemption from the applied to the appreciation of the real estate investment. So if $1 becomes worth now $3 over a 10-year holding period, the $2 in appreciation is now tax exempt. You pay no capital gains associated with the appreciation at terminal sale. And we believe this is a tremendous tax shield. It is a gateway to invest in real assets. Pinnacle Partners has been exclusively focused on multifamily projects. of institutional size and quality. And we think that that particular product is ideal for the opportunity zone investment and the associated holding period of 10 years. So those are the two benefits. It starts with a capital gain, and there's a number of qualifications thereafter. So we wanted to get straight into the Q&A with Brendan. And Brendan, you can lead the conversation on the qualifying parameters. And as I suggested, speak to the proposed legislation, the potential impact on investing this year and next year. And then routinely we get asked about 1031s. Can I do a partial 1031 investment and then allocate to the opportunity zone? What are some of the playbook associated with 1031 versus OZ? So those are some of the subject matters, but we'll be monitoring the chat. So please submit your questions. And Brendan, why don't you tell us about your firm and your business focus in opportunity zones?
Sure. Our firm, BMMS Partners, is a tax compliance, tax planning primarily firm based out of Bellevue, Washington. My practice is probably 70-75% real estate related clients, a lot of syndicated real estate ownership and development. And opportunity zones are just a natural extension of that. So 2018 came around, I spent a lot of time getting up to speed on the law and the regulations, going on sort of the circuit tour of doing a bunch of speaking on this. And as Jeff and Leo recognized separately, I recognize that this is perhaps the single most powerful tax tool available to people right now. There's unlimited upside gain exclusion that's available under the opportunity zone regulations. And then separate from the taxes, I think it's going to be a very transformational provision that helps a lot of developments get done in what are historically low-income areas. And so the idea is to free up capital that's otherwise not moving as a result of the tax implications associated with capital gain. So to take advantage of any of the opportunity zone tax benefits, you need to be starting with a capital gain. That capital gain can be almost anything. The sale of appreciated stock, up until 6 months ago, we're in Puget Sound, so Amazon, Microsoft, Google, Facebook, all that appreciated tech stock was a really great source of capital gains, and it allowed you to tax efficiently get into a different asset class, get some diversification. Sale of business, sale of real estate, pretty much anything that generates a gain that gets reported as a capital gain on your tax return is eligible for reinvestment into a qualified opportunity fund. The timing considerations around when and how to make an investment are, I would say, conceptually easy to understand and a little bit more nuanced to execute. From the investor point of view, you have a qualifying capital gain transaction, and then within requisite 180-day reinvestment period, you reinvest those capital gain funds into a qualified opportunity fund, QOF. Now, the nuance is that 180-day reinvestment period can start at different times depending on the type of gain that you have, as well as how that gain is reported to you. So from its most basic sort of example, if I have appreciated stock that I own personally and I sell it on January 1st, I have 180 days, including January 1st, to reinvest those capital gain dollars into a qualified opportunity fund. If you are selling an asset that generates a capital gain that gets reported to you on a K1, you think, if you have a real estate asset and you have a couple of partners, it's usually owned in an LLC. You sell that, your gain gets reported to you on a K1, and then you report that gain on your personal tax return. Those K1 gains can actually have 3 different potential start dates for that 180-day reinvestment period. You get to choose one of these 3 dates, not mix and match, but you can elect to have that gain reinvestment clock start at the underlying date of the asset sale, at the last date of the partnership's tax year, which is generally December 31st, or on the unextended original due date for the partnership's tax return, which we'll just call March 15th. So hypothetically, in year one, you could sell an asset on January 1st, and your reinvestment period could go as far as into September of the following year. So don't self-select out if you have gains coming to you on a K1 that you think, oh, that happened too long ago. I don't think I'm able to do that. That's one sort of low-hanging fruit area where we often see people misapply the law or not realize what they have available to them. Speaking to the proposed legislation, there is the Opportunity Zone Transparency Extension and Improvement Act, which was proposed in Congress on April 7th of this year. It actually just 2 days ago got read in the Senate Finance Committee meeting. So there is some action being taken on this. And this legislation would be a huge win for the Opportunity Zone world for a variety of reasons. One, it allows funds of funds. So you could have a feeder fund that feeds into an Opportunity Zone fund, which is currently not permitted. It would sunset some Opportunity Zone areas, but it would also redesignate new ones. So there would be sort of a second wave of properties that would, or areas that would be considered for investment. There's actually, Jeff mentioned 2 tax benefits. There's actually a third tax benefit for Opportunity Zones that currently has expired, and this legislation would bring that back. If your Opportunity Zone investment is held for 6 years before these original capital gains come due, then this is under the proposed legislation, you would have a 15% basis step up. What that means is if you had $1 million gain and you invested that gain into a qualified opportunity fund, that tax is deferred. And if you held that investment for 6 years before that tax came due, instead of paying tax on $1 million, you would only pay tax on $850,000. So there is a 15% permanent exclusion of income from tax associated with those deferred capital gains. And that, under the proposed legislation, in order to take advantage of that provision, which is significant, you would need to get your investment completed, your reinvestment into a qualified opportunity fund before December 31st of this year. So that is the benefit to investing in an Opportunity Zone this year versus next year if you're on the fence. As I said, they're going to, under this proposed legislation, if it were to pass, they would redesignate, they would sunset some Opportunity Zones, they would create new ones. Investments made in Opportunity Zones that were sunsetted under this legislation would continue to enjoy the tax benefits associated with everything Opportunity Zone. It would just prohibit new investments into those areas. Taking a peek here if there's anything else that I think is relevant on the Opportunity Zone side, but from this act. And one of the things that this Opportunity Zone Transparency Extension and Improvement Act does is require a little bit more transparency. And so that mandates both on the fund side and the investor side some additional tax disclosures, not additional tax liability, but there's additional information that would need to accompany your tax return. It is required to be provided to you by the fund. Pinnacle does that right now. But if you neglect your reporting responsibilities as an individual investor, there are really hefty penalties associated with not following the compliance and reporting requirements, starting at $5,000, going up to $25,000 for intentional disregard. So this proposed legislation would provide additional clarity into opportunity zone investments and effectively where they're being made and the aggregate dollars invested.
That burden of compliance falls on us, and we provide the necessary information to our investors. A couple of quick questions here, if I may, Brendan, around the proposed
Absolutely.
legislation. So let's just go through this real quick. We've got the assuming it passes, and you suggest there is activity even this week. It is bipartisan. There is largely optimism that it will pass. It may pass in the lame duck or sometime in 23. If I invested in 21 and the proposed legislation is passed, what effect is that upon a 21 vintage investment?
Sure. Investments made in 2021 generally qualify for a 10% basis step up with respect to that original capital gain. So using the same example, $1 million, when the tax came due, you'd only be paying tax on $900,000. This legislation would retroactively give you an extra 5% bump up there. So you would get another $50,000 benefit in our example.
Outstanding. And if I had invested earlier in 22, 0 step up in basis, but again, assuming again I invest in 22, so retroactively I would enjoy the 15% step up.
Correct.
And if I invest in 23, then I earn a 10% step up in basis. Is that correct?
That is correct. Yes.
Okay. And the deferral has moved to 2028.
So
instead of 2020.
the tax would come due December 31st, 2028, and would realistically get paid in Q1 of 2029.
Very good. And the elimination is in place and is unchanged.
Correct.
Okay, very good. And then going back up top to the qualifying parameters, we spoke about the 180-day rule. It differs by type of gain. Partnership K1 may have differing dates in which the clock begins. And can you speak around the ability to still affect positively your 22 return by investing in 23? Absolutely.
So assuming we're in a situation where you get a K1 that gets gain allocated to you, you have potentially up to, just over 8 months. It's a date early in September, 9th, 10th, 11th, something like that, in which to make a qualifying investment. And then retroactively, that reduces your 2022 tax bill by the amount of tax associated with those deferred gains. And let me take a step back too. If you have the sale of assets held directly by you that happens in the second half of the year, and your 180-day reinvestment clock spans 2 years, some portion of it in 2022, some portion in 2023, a qualifying investment in 2023 has that same impact of being able to, after the close of tax year 2022, go back and positively impact your tax situation by reducing the amount of capital gains tax that you owe.
Very good. And then can you, I failed to remark about the use of depreciation, one of the other benefits that applies to all real estate, of course, but in the case of an opportunity zone project, there is no recapture of depreciation.
Totally true. So the 10-year tax benefit works by stepping up your basis in your investment all the way up to whatever the fair market value is of your proportionate share that's sold. And what that means is the more depreciation deductions that we can take, the bigger that 10-year tax benefit is, as there is, as Jeff pointed out, no depreciation recapture tax under the opportunity zone tax provisions. And one thing that I think I would also want to point out, since I know you guys have a number of projects in Washington State, is that Washington State has a capital gains tax that is currently under judicial review. We expect some action by the end of January, at least in the form of some opening arguments in a case supporting whether or not it is constitutional for the state of Washington to have a capital gains tax. Relevant to that is that real estate is exempt from that capital gains tax. So future gains from a Pinnacle development that generates capital gains associated with real estate would escape tax at both the federal level and at the Washington state level.
Thank you. Thank you for that. Well, let's move to 1031s. This is specific to a real estate sale only. 1031 exchange has been in place for some time and provides some tax benefits. Certainly, it seems like a perpetual deferral. And the OZ, when compared to the OZ, gives you, I think, added flexibility. So maybe you could talk about the differences there. And then there are some nuances. We get a lot of questions about, the ability to invest in both, a portion into the OZ, a portion into 1031.
Yeah, and I'll start just kind of comparing and contrasting 1031 exchanges and opportunity zone investments, and then kind of touch on how can they play together nicely, which it takes a little bit of front end work, but you can make it work. A 1031 exchange, like kind exchange, allows you to sell real estate and reinvest into other real estate without triggering tax in the interim. In order to do that, you have to put every dollar of that first sale back to work into the next deal. So you go up in asset basis, you go up in debt. You can't touch the money in the interim. You have to use a qualified intermediary. You have to identify property within 45 days of the sale. You have to close within 180 days of that original sale. It's a powerful tool for deferral, but the overall plan with a 1031 exchange is defer, die, get a step up in basis, and then you can sell the asset. Opportunity zones have similar characteristics, but a little bit more added flexibility when compared to a 1031 exchange. First thing is, you're not dealing with every dollar in a sale, you're only dealing with the gain dollars. So if you bought something for $3 million and sold it for $4 million, under the 1031 exchange, you would need to put all $4 million back into play, where in an opportunity zone situation, you would only be talking about the $1 million of capital gains, and you could take that $3 million off the table and do whatever you want with it.
And if I may interject, that's tax-free. Your basis is tax-free.
It's a return of your basis, so it's not a separate taxable event. Yeah, you get your money back tax-free. That's fair. You get to touch the money in the interim. You don't have to use a qualified intermediary. The 180-day, as we talked about, reinvestment period is a little bit more flexible. A 1031 exchange in the context of a real estate partnership that has multiple partners, that is an entity level decision. Either everybody's in or everybody's out. And the opportunity zone provisions allow some people to make an opportunity zone investment that want to, and others that don't can elect to pay the tax and go their way. So there's added flexibility amongst the partners there. And then in terms of how, let's say you're under contract to sell real estate, I want to do a 1031 and I want to do an opportunity zone. How does that work? The easiest way to get that to work is to determine how much you want to use for opportunity zone investment before you close your deal, and then segregate those funds separately from the funds that would be otherwise going to the qualified intermediary who's executing your 1031 exchange. So again, hypothetically, let's say you're selling something for $4 million. You've got $3 million that, or $500,000 that you want to put into an opportunity zone fund. You take 500 off the table into a separate account. 3.5 million would go into your 1031 exchange transaction, and that 500,000 separately would then be available for deferral into an opportunity zone fund. It's kind of hard to back into it. If you set everything up as a 1031 exchange, there's some questions as to when the 180-day reinvestment period starts for a 1031 exchange that starts and ends in the same tax year. It gets a little bit more complicated. I'm not saying we haven't done it. I'm not saying it can't be done, but to the extent that you can pre-plan for investment into an opportunity fund before you try to execute a whole or partial 1031 like kind exchange, the better it's going to work for you.
Excellent. Thank you, Brendan. I'm going to launch a quick poll question. If the audience can take a look at that, we appreciate your response. And we're also seeking any questions for Brendan now that we've reviewed the qualifying parameters, the proposed extension, and did a comparison and contrast to 1031. Appreciate the responses.
I guess while everyone's filling out this poll question, one question that I've seen come up is, what if I sell my house, which is a personal asset, and there's a gain on that? The general rule, we're going to talk about a married couple filing jointly that sell their house. The general rule is that you get to exclude up to $500,000 of gain on the sale of your primary residence from tax. Anything in excess of that $500,000 would be taxable to you as a capital gain and is therefore eligible for reinvestment into a qualified opportunity fund. So, owned your house for a long time, you sold it for a big gain. You can take that $500,000 of gain tax-free, but anything in excess of that is absolutely eligible for reinvestment into a qualified opportunity fund.
Excellent. Thank you, Brendan. And we have seen a lot of those types of transactions. Question here, somebody is a California state resident, places an investment in opportunity zone and relocates before the deferred tax is due in 2026. Can you opine on whether or not the state of California has any rights to impose their capital gains tax at the state level?
California does not conform to the opportunity zone tax provisions, which means that at the state level, if you were a California resident and you sold something for $1 million capital gain and you reinvested into an opportunity fund, you would pay no federal tax in the year of the sale. It would get deferred until the end of the opportunity zone rules say you have to pay tax on it, but you would be paying tax at a state level. So California would immediately tax that. So if you relocated, into a different state and subsequently the tax came due in 2026 or 2028, depending on if the legislation get passed, California would not have claim to tax those gains.
Okay, very good. Couple more quick questions. What happens in the case of death?
The opportunity zone benefits and burdens pass on to your heirs. What that means is that if somebody were to invest in an opportunity fund and then pass away before 2026, that deferred tax liability follows the investment to the heir. So they would inherit a tax liability coming due in 2026. However, they would also inherit that huge 10-year tax benefit. So
and they also are, I'm sorry, but they're also earning the proceeds associated with the investment, given they are the beneficiary.
Absolutely accurate. Yeah, they effectively step in the shoes of the original investor. It doesn't accelerate any gains. It doesn't restart any clocks with respect to 180 days, 10 years, whatever it is. They step in the shoes of the original investor.
Okay, thank you. And we, many of our investors have worked within a trust, a GST, a generational skipping trust. So it's very flexible that way. I failed to mention, but given our early partnership, Brendan, beginning 2018, as I mentioned, early days and pioneering in the OZ execution space. We actually transacted an early sale of an asset. Can you speak? I know it's very complicated subject matter, but can you just speak to the process if an early sale is transacted, the reinvestment opportunity to retain the tax benefits?
Absolutely. And so what Jeff is alluding to is you make an investment into a qualified opportunity fund. That fund then invests into an asset that they intend to hold for 10 years. Somebody comes along and it makes you an offer you can't refuse, and you have to sell the asset because it's such a good price. What happens? Well, you sell that asset. That is disqualifying disposition before 10 years, so that gain itself is not subject to exclusion under the opportunity zone tax provisions. However, you can redeploy your originally deferred capital gains, the money that you first put into the qualified opportunity fund. You can redeploy that into another opportunity zone project without impacting your original investment timeline. So you invest in 2018, you sell in 2021, you reinvest, the fund reinvests into a new asset in 2022. You're already 4 years into your 10-year clock. You don't restart that 10-year clock with respect to those originally deferred capital gains. Now, you have a new capital gain associated with the sale of this asset. That gain is also available for investment into a qualified opportunity fund. You need to follow all the rules as you would with any other gain. That gain itself does have a new 10-year clock, but it could be going into a totally different separate project that wouldn't impact your originally deferred capital gains.
Very good. Very good. Well, thank you. So this has been really helpful. We've covered a lot of ground on a variety of subjects. I want to make a couple of comments. First, the program has been wildly successful in stimulating investment and economic activity. Thus, the proposed extension to continue the program. Numbers have varied between 70 billion and 100 billion of capital gains invested. You could put a multiplier on that of 7 or 10 times the effective economic activity, and it's been, very, very successful. Of course, we invest almost exclusively in multifamily. We think we're helping to solve the housing supply issue. And the program, although we just talked about some very complicated subjects, is self-administered. Just a single form, IRS form attached to your return. And we have a question here. I think I'm going to answer it. And maybe Brendan, you can also provide context. But you simply schedule the gain in the vintage of the gain, 2022 or 2023, and then you offset that gain, so to speak, pair that gain with the opportunity zone investment. And then you're affecting that specific gain in 22 or 23, assuming it's still within that 180-day period.
Yeah, if you have multiple gains with overlapping 180-day reinvestment periods and you make a qualifying investment, the IRS does not prescribe which gain that you have to use first. You get to choose. So there's a lot of flexibility, and that's relevant when we're talking about not only gains between different tax years, but different kinds of gain, short-term gain versus long-term gain. Short-term capital gains are also eligible for deferral into a qualified opportunity fund.
And thus they're deferred at the higher rate.
Correct.
9.4%. Excellent. Okay. Well, Brendan, if you can stay with us in the case that there's more questions. The poll results have come back. A great many of our attendees either have invested this year or seeking to invest still this year. So if you have an actionable gain, it meets the qualifying parameters that we just reviewed, then we would like to provide you an update on the Pinnacle Fund 8. I'll bring in my partner, and co-founder Leo Backer to review what we think is one of the most attractive, highly curated, and identified boutique fund of 4 OZ assets.
Thanks, Jeff. And Brendan, we've been doing this for over 4 years, and I learn something every time I hear you talk about opportunity zones. So really appreciate your partnership. And before I go into our portfolio, I just want to add that Brendan and his firm not only helps us in, with our investors, but he also helps us with our development partners, because many of our joint venture partnerships, the developers have never done an opportunity zone structure. And they're very complicated, especially if they already own a land and want to participate in the deal. So if any of you have real estate and want to consider, developing and participating in opportunity zone developments, we've done that several times. It's complicated, but it's doable, and it's a good way to really realize, benefits in land you already own. So, Brendan, again, thanks for your partnership. So I'm going to do a very high-level review of our Fund 8. As Jeff mentioned, we've capitalized, we say 14 projects. 10 of those were in single assets in Washington and California. And like Jeff said, majority are multifamily, either student housing. We've done one affordable housing project, many workforce housing projects close to light rail, kind of hitting that missing middle income level. And we launched the fund about a year ago. Several of our investors asked us to look at markets outside of Washington. And they also wanted to look at a diversified portfolio so they could really underwrite Pinnacle in our fund and our delivery instead of looking at each project individually. And so a year ago, we launched Pinnacle Partners Opportunity Zone Fund 8. We brought on a partner in the fund, Jill Homan, who is in North Carolina early on in the Opportunity Zone business as well, has done development, and has worked with several family offices that really allowed us to scale across the country. And we also added a newer advisory board, which allows us really deep knowledge into the multifamily markets in our due diligence. So we really added to our team nationwide and feel, very good about our execution. And as you can imagine, in the last, literally 60 to 90 days, the markets really turned quite a bit. And we think to our advantage. We're very happy that early on, we had these markets that you see on the map here, targeted for our fund. We're following, markets with high job growth, people moving for quality of life, positive business environments, et cetera. So, no surprise when you see these markets that we're really focused in. But even that's changed over the last 90 to 180 days because, the world's changed. Some markets have gotten overbuilt, overpriced, and, are certainly not seeing the rent growth as they have in the past. And a lot of them are seeing a pretty big dip. So we are continually being very selective. And this curated portfolio of 4 projects that we note here, we did not want to be a blind pool fund. So initially, right when we launched the fund, we had a project in Denver, Colorado. And Jeff, if you want to maybe move on to kind of the Denver slide, we were very happy to secure our first project in Denver with a development partner, Mortensen Construction, who is not only the developer, but also the general contractor. And we're pleased to announce that we're going to be breaking ground on that project in February to March of next year. We're closing on a construction loan this month. And, that neighborhood next to the Broncos Stadium and adjacent to downtown Denver, we think continually is seeing rent growth. And even if it slows down, our underwriting on this project is very conservative. So about 200 units of market rate housing, adjacent again to the Broncos Stadium in downtown Denver. We have our GMP with the general contractor locked in, a construction loan set, and again, ready to break ground first of the year. So we're very excited to kind of be moving on project number 1, imminently. And project number 2, we've also had our joint venture negotiated for several months on this project in Nashville. Many of you have probably heard about this one, but this is also in their entertainment district, very close to the Titan Stadium, which is now, in final approval to get redeveloped. And we are right smack in the middle of not only the Nashville Stadium district, but also downtown Nashville and the new Oracle campus, bringing almost 10,000 employees. So we're very excited about being early on. We closed on land in this development, and we are working with the city now as they kind of re-envision this whole entertainment district to how we position this project. But we're envisioning starting construction on this project Q3 to Q4 of next year. The third project is one that, again, in Austin, Texas, has been a very frothy market. We've looked at a lot of projects in Austin that, frankly, we've backed away from because we're fearful of being, really last ones in and paying a premium. But this project out by the airport is a garden style project. We're in final negotiations with the developer on, and just a little bit of a narrative on how we're negotiating our joint ventures. This project and even Nashville, we're really looking hard at how we negotiate our partnerships with our developers, because today there are fewer funds out there that are able to raise the equity like Jeff and Blake have been successful to do. And we think we've got more leverage now. So we're being very careful. We aren't allowing land lists, no profit on land if a developer already owns the site. We're trying to backload the profits for these developers after our investors have made a reasonable return. So it's taking us a little bit longer to get these negotiated, but we are doing our best to de-risk these developments for our investors. We're not overpaying for land. We are, again, backloading these developer profits. And this one we did have to frankly go back and retrade a bit, but we feel very good about this development and the structure we have in place now with this developer.
And this is located near Tesla Gigafactory and Samsung Fab and other manufacturers and business center.
Exactly. And in this environment, we've been really keen on focusing on garden style projects like this project, where you're not having to build structure parking. So it's lower cost of construction, it's quicker to build. And we think it's a type of product that a lot of people now are looking for, larger units that are close to town, but not right in downtown. Mm-hmm. And then the fourth project is one that we're also closing on our joint venture in the next week or so, is just outside of Phoenix in Avondale, Arizona. And this is very close to Glendale, where their football stadium is located. It's in a mixed use development. Avondale is a kind of a bedroom community with a lot of growth, very good school districts. And we've probably looked, Jeff, at more projects in Phoenix than just about anywhere, and just kept passing because we thought there was a pretty low barrier of entry in that market. You can keep building and building and building. But this is a single family rental product, which we're looking at a lot of projects. You've probably heard and read about single family rental, which is basically building either townhomes or smaller detached homes for rent. And our development partner, Trilogy, out of Atlanta, has several of these projects that they've got under contract. This is our first project that we'll be doing with them. That is all 2 and 3 bedroom, single family rentals in a mixed use development. So there'll be 2 hotels. There's a Costco within about a half a mile, and a shopping center, ball field. So we really like the diversification of the product type in our portfolio with this single family rental, garden style, and then the podium construction that we're doing in Denver and in Nashville. And again, the way we've negotiated our joint ventures, we think we've de-risked the developments. We're only partnering with developers that have the horsepower to bring in very strong banking relationships, which is very important today. It's very hard to get a construction loan in today's world, and our development partners all have the balance sheets and the reputations to have banks that want to provide construction loans for them. And then lastly, with our advisory board, I would say we're changing a bit on our underwriting. We're even more conservative than we've been. Hard to know where interest rates are going to be at permanent loan time, and where exit cap rates are going to be. So, you know, we're increasing our net investor return threshold for where we were previously to a number that we feel better that, you know, we've got some room, you know, in these markets that we're in. But so we're very, very happy about the markets we're in. We're finalizing our joint ventures on these last two projects. As I mentioned, you know, Phoenix will be this week, Austin likely right after the first of the year, and we'll have our fund of 4, you know, ready to move ahead on. So that's kind of high level. We're, you know, Jeff and I are available at any time to give you a higher, you know, a deeper dive on these projects, but we're very excited about this portfolio.
Thank you, Leo. And so maybe we can move to close here. If there are any other questions, please put them into the Q&A box. I do want to be clear that if you have an actionable gain, if you're seeking to invest before year end, this particular fund of 4 is open and available for investment. We have a qualified opportunity fund. And so, Brendan, if I can bring you back, because we get a lot of questions about, again, kind of triggering the benefit. Some people say, well, does it have to, you know, does construction have to begin, or permits in place, or, you know, what is the qualification? And what it is that your subscription is executed, the funds have been delivered to the qualified opportunity fund, and as soon as that transaction is complete, you then instantly qualify for the first of 2, potentially 3 benefits. But the first major benefit is the deferral of the capital gain tax in that year. We're assuming now 2022. That is all that is required to qualify for that number 1 benefit. Is that a correct statement, Brendan?
Yeah, from the investor side of things, execute your subdocs, transfer the money. That is a qualifying investment into a qualified opportunity fund that you can then report on your tax return and defer those capital gains.
And in this particular Pinnacle Fund 8, the fund of 4, highly curated, as Leo described, our target markets, and now high quality projects secured within those markets. $1 is invested into the QOF, and you are participating pro rata in each of the 4 projects. So a quarter allocation in my dollar example to each of the 4 projects. And then the administration, as we said earlier, again, we've talked about a number of complicated issues, but this is a self-administered program. And maybe you can, I have found, and Brendan, you can add if you wish, I found the IRS FAQ for opportunity zones to be extremely helpful, maybe the best out there. And it's just really easy and very simple to administer. And if any tax advisor is unaware, that's a great resource. And of course, you're available, Brendan, to talk about any more complicated scenarios from any of our prospective investors.
I am absolutely available. And when it comes to the personal side of things, the instructions within Form 8949 and Form 8997, which are the 2 forms that the individual investor is required to fill out in the year of deferral, have very straightforward, easy to understand instructions on the how to report your deferral and investment.
Excellent. Good. Well, Brendan, we thank you for your partnership and your time and your expertise. We hope this has been productive and constructive for everyone. And if there are any questions, our colleague Blake Backer is available. His contact details are shown on the screen. And with that, I think we'll come to close here. Thank you very much for your time.
Thanks, everybody.
Bye-bye.